Here's why holding stocks long-term doesn't make any sense at all for most people. This video will blow your mind. It will be the most valuable YouTube video that you watch this year. Just watch the first minute of it and you'll have a whole new outlook on what is the conspiracy theory of holding stocks long-term. If you hold a stock longer than a year, you are actively giving away 5% of your money. Here's how. When you hold a stock long-term, you're taking away your capital, your ability to buy and your ability to leverage. To give an example, with this capital, within a year, you could earn 4 or 5% simply putting your money in a certified deposit or a savings account and earning interest. Taking that into account, whatever growth you get from your stock that you hold long-term over the interest that you'd get from a certified deposit or savings account of 4 to 5% has to be worth all of the risk and volatility between when you buy a stock and when you sell it, potentially a year later. To give a more specific example, if you even expect the stock to earn 9% in a year, while you could instead have a guaranteed 5% just leaving your money in a CD or certified deposit or a savings account, you are effectively betting 5% in missed earnings, plus any losses from the stock's price actually decreasing, for a possible 4% gain. Another way to think about it is you are giving up 5% of your money to be able to bet on a stock. I mean, that's the whole video right there, but I'll go into more details, and there are some pros and obviously more cons on why holding stocks long-term is just a terrible idea. But secondly, here's one basic principle that's important to understand. Unless there's a reason for a position to move, one shouldn't be taking the position. In other words, unless one can explain why a stock should go up, or more accurately, why others will buy into it, they themselves shouldn't be buying into the stock. Otherwise, you might as well just go gambling in Vegas, because then you're just blindly hoping for something good to happen. So, smart traders will capitalize on opportunities that they see while minimizing risk to volatility. Some may do this with hedging, perhaps with options or other opposite securities. However, of course, the best way to minimize risk is to not have any positions at all. But that's no fun, is it? So the question becomes, when will a stock move? The majority of the time, the volatility in the stock market is facilitated by institutional and retail traders, looking for patterns in how a stock trades to predict a move. However, once in a while, there will be a piece of news that either indicates something about a company's performance, such as an earnings report, or has a direct material effect on not merely the performance of a company's stock, but on the performance of this company itself. This news is what proficient long-term investors really mean to take positions on. But why would someone hold a stock for a year on the premise that the company will grow if they can just buy before quarterly earnings and sell the next day when people realize that the company has grown? Well, here's why someone may want to hold a stock long-term. Number 1. Long-term capital gains tax. In the US, if someone holds a security for longer than a year, they are able to pay less tax. Securities held for under a year are subject to short-term capital gains tax, which is taxed the same as ordinary income on the federal level. However, if someone holds a security for longer than a year before selling it, they can pay a smaller tax, known as a long-term capital gains tax, which itself is also based on their tax bracket, but it ranges from 0 to 20%. But at least on the federal level, someone with the highest tax bracket would get to save a little less than a fifth of their gains on their security holdings if they hold the security for longer than a year before selling it. Number 2, news at an unknown date. So this is more complicated, but essentially, if someone thinks that there will be upcoming news in the near future, then they may take a position expecting that if and when the news is released, a stock will instantly react accordingly. However, doing so wouldn't really make sense long-term to me unless the predicted news is basically insider information that will make or break a company and that only a few investors realize. Here's what I mean. If the news isn't important enough, the volatility between now and when the news is announced may easily offset any gains from the stock reacting to the news, and if everyone already knows when news is upcoming, then the impact of the news would likely already be priced into the stock, making taking a position based on this itself baseless. However, another reason not to hold stocks long-term, especially for active traders and even short-term investors, is stable growth. See, if you are an active trader or a short-term investor who's able to take multiple positions and leverage each one with a small amount of money each time in diversified positions, then you could make so many trades that you would have so much quantity to the point where it provides a framework for stable growth. At least much more stable growth than just holding a stock long-term when the stock can drop 2 or 3% in a day, or 10% in a day if Trump is president. The thing is, most people just have seen these charts of large indexes like SPX just growing at 10% a year over the past 100 years when the American economy actually grew, and they just expect for these trends to continue. But if you've been alive for the past 3 months, again, that's not how the stock market works. Okay, but that's the video. If this video helped you at all, like and subscribe, comment below, and I also do analyses on companies that are about to report earnings. So if you'd like to see that in the future, subscribe and potentially see them as I upload in the future. And of course, I'll make content similar to this in the future as well. So if you'd like to see more of that, subscribe.